true wealth is actually built by making very concentrated and deliberate and high conviction investments.
From All Street Capital, this is the All Star Podcast, where successful investors and business builders reveal the process behind the outcomes. We unpack the choices, trade-offs, and turning points that define their long-term success. Welcome to today's episode. Let's jump in.
Alvin, welcome to the show.
Hey, thanks, Austin.
Awesome. So, Alvin, tell us what you do and the firm you founded. What's your story here?
Sure. Well, basically, my story is that I've been in wealth management for over 15 plus years. Started off in the US, started off at Charles Schwab, and then I worked at a large RIA firm in Los Angeles. And that was a great experience because I really got to see how institutional money management worked. And then I ended up at HSBC Global in Hong Kong. So that was a great experience because I really got to see how kind of large global banks and private banking worked. And then what was really cool about that experience was that I worked with a lot of global investors. So high net worth individuals with a lot of cross-border. I didn't believe that, every single client really had to fit into one product. So that's kind of what kind of led me to thinking through, what's the best way to offer advice. And at the end of the day, I decided to just form my own RIA firm, a registered investment advisor, back in the US in the Bay Area.
Is it hard to start your own firm?
Well, I would say yes and no, right? Because if you don't have a lot of assets to start, yes, it's hard, right? So, because there's different types of advisors have different stories, right? Like with my story, like I already had a couple very strong relationships with clients that I've worked with over the years. And so having the initial client base was super, super helpful, right? Because if you're starting from zero assets, you've already got that pressure going because you've got all these expenses and fees, right? Austin, you start your own company, right? You've got all these startup costs, fees, setup costs, clients fees, attorney fees, the list goes on. And so the tech stack. So having that cushion was nice because at least from day one, I already knew I had a client base. So in that sense, it was pretty cool. In the other sense of starting a firm from scratch, it's definitely challenging, even if you have clients, because you're basically competing with a very, very crowded market already, right? Again, you know exactly because you're also like an entrepreneur, right? So I'm going up against multi-billion-dollar RIA firms, right? So in the very beginning, right, you're doing everything. You're doing all the research, you're doing all the compliance, you're doing all the you're doing all the portfolio management, you're doing all the client relationship management, you're running the taxes, check out the tech stack. Tech stack is constantly changing, so you always have to be on top of that. So yeah, it's definitely quite a challenge.
Lot to do.
Yeah, so that's kind of a typical story.
Right. So how would a client choose between a boutique versus a wirehouse or a big RA firm? What's the benefit of a boutique?
Yeah, it's a really valid question, first of all, right? Because clients have so many choices these days. So you've got like robo-advisors, and you have, the private banks, you have large RIAs, and then you have firms like us, kind of the smaller boutique firms. So, I always tell clients, you always want to work with someone who you're very comfortable with, that really understands your situation. We know our clients, really, really well. Literally, my clients will send me a WhatsApp any time of the day. Being smaller and more boutique is that we're more nimble, right? Because like if you work at a larger investment firm where, you have these large investment committees, right? And I know because I used to work at, big banks and a large RIA firm where everything has to go through multiple committees, right? Before something gets implemented. And you came from investment banking, so you know the drill.
I used
right?
to write 50-page internal memos. Yeah,
Exactly.
it's highly unnecessary. So I think I totally get the point. So who's your ideal client?
And I'll just kind of put it out there, Austin. Like, we're not your typical RA in the sense that we'll put you in a diversified portfolio and we'll kind of ride out every storm, and then we'll kind of put you into index funds and to maybe do some bonds, 60/40, some international exposure, and then we'll kind of recheck with you, recheck in the plan, every year, and hopefully by the time you're 60, you'll have a really nice retirement plan, set for you. So we really aren't that type of advisor. I'll just kind of throw it out there right now. because
Okay.
that's
But that's already nice. So I have a lot of savings at the 60. That sounds good though. All right. So what's
yeah.
better? Tell me
And
what's better.
yeah, yeah, that can work great, right? So there's nothing wrong with that. A lot of people are very happy with that plan, that kind of long-term plan. But a lot of the clients that we work with, they actually want more optionality, right? And so what that means is optionality is to say they're working at a growth tech firm or technology firm, or even doesn't have to be tech, right? They're financial professional, but they're super, super hard charging, right? And, very intense. They're making great income, okay, but then they're pretty sure they're not going to be able to do this for another 20 years, right? Maybe I want some more optionality. So for some clients I work with, it's early retirement. How do you give a client optionality? Do that by really front loading their growth in their portfolio in their early years, rather than trying to look at it from a 40-year, like a 40-year type problem, right? You want to be able to say, okay, how much can we grow your portfolio in the next 20, 25 years, right? And so it's just different way to think about it, right? And so we have these discussions with our clients, and that's kind of where they look to us, is because we can build portfolios that are really going to target of giving them that optionality, where if we can grow your portfolio at a certain rate for the next 20 years, right? In that time, the portfolio value we would expect would be X amount. And that would then give you the option to say, okay, cool. Maybe at this point, I don't have to work until I'm 65, right? I can just kind of decide if I even want to work until I'm 60, and then look at other options on the table.
You set yourself with a tougher mandate, which is you're accelerating people's growth. And I would love to understand how you do it, especially, if you ask any person, would you want to retire early? I think the answer would be yes. So you have a very compelling proposition. And I would love to know, what's your approach? Is there any thesis that is behind it?
Of course. Yeah, definitely we can talk about that piece, because that's really important, right? So, if you look at kind of the how to go about, structuring a portfolio or an investment strategy where you have the potential to give clients that optionality that we just talked about, right? Really, there's a few ways to do it, but the primary way is really to accelerate your savings rate. Okay, that's number one. Very obvious, right? Like the more you save, obviously that's going to be used towards growth, to build up your base for growth. And the second way, of course, is looking at the type of investment strategy, right? So the problem with our industry, Austin, is that most advisors are kind of have a very set way of doing things, which is kind of, will build you this diversified portfolio, right? And typically their benchmark is the S&P 500, right? And then for bonds, they'll use kind of the aggregated bond index. And so the problem with that is that, the S&P is one benchmark, right? But it doesn't have to be the only benchmark you can use to target your retirement, right? Because there's no rule that says you can't target to have a higher return than the S&P, right? So true wealth is actually built by making very concentrated and deliberate and high conviction investments, right? And that's actually what grows your wealth. I mean, it's actually funny because, when we talk about, risk and investment, if you think about all the wealthiest people, and not even just the Elon Musks, right? But even just people who work in tech. Like if you think about an engineer at NVIDIA, now they've been there 20 years, right? Like if
Mhm.
they just kept all their RSUs, if they didn't, if they were standard advice was selling their RSUs every single time, these people have multiple millions in net worth, right? Because they simply built their wealth from very concentrated and very intelligent conviction, right? So NVIDIA is a great example of that, right? That's not the only example. And you think about Austin, we live in high expense areas, right? Silicon Valley.
Yeah.
A lot of our clients live in Los Angeles, in New York. I mean, if you think about that, right? Like the cost of a home, all your taxes with state taxes, you're getting close to in the 40s, 50% tax rate. I mean, children, kindergarten, daycare. I mean, all those expenses in those high cities, even with a 500K salary, after all the taxes and your expenses and your property taxes, I mean, really, you still don't feel that rich, right? Like, so this is where it really comes in, where, it really makes a big difference in terms of how hard your portfolio is working for you. And if you've just got a standard kind of diversified mix of stocks and bonds. But even if you're getting averaging a decent 8 to 10% a year, it still may not be able to really move the needle enough for you because you're feeling the lifestyle creep. You're feeling the high cost of living in all these, on all these cities.
Yeah. How do you actually approach the stock selection or investment selection? Like, sounds like you're running almost a hedge fund where you are betting on a small number of bets to play out over a period of time that is actually different for each client. And that is, I would say, a collection of micro funds, right? Which is very hard to do.
So our approach is definitely going to be a lot more intensive in terms of the research. So I would say the first thing we have to do is we spend an inordinate amount of time on research, right? So like my partner, he's full-time research. So that's all he does every day, all day long. So research is going to be where we have to kind of do our due diligence, understand the companies we invest in, really have to dig deep, look to see if the thesis has changed. We're not just looking at fundamentals, but we even look at technicals because you can pick the right stock, but if the timing is off, you could still be in a situation where you're kind of having to wait until your clients really see that growth, right? So we always have to look at both the entry point and the right asset to buy, the right company to buy, and of course we also have to look at exit points, right? It's very
Mhm.
interesting because in our industry, no one talks about stock picking, everyone talks about planning, right? And we totally agree. Planning is absolutely important. And I do planning for all my clients, right? It's like I do tax planning, I do retirement planning, RSE planning, because some clients, as we talked about earlier, they actually want to have more active management in their portfolio. They actually want to target having, that higher return, and they're okay with having the higher volatility. Typically all of my clients have a minimum of 10 to 15 years or longer time frame. That's very important to keep in mind. Is like our approach is not going to work for someone who has a 5 year time approach. We need that long term approach to give our portfolios the growth, the runway. So it's like we definitely don't have a set it and forget it strategy. So even though we have a core portfolio, a kind of a core list of names that we track, that we hold, that we buy for clients, we can always change our thesis. So that's something I'd say is very, very important to keep in mind is you have to have that flexibility. Whereas, I have no clients who work with other advisors and, they feel like, well, my portfolio hasn't moved, it's really not reflecting a lot of the trends I'm seeing in the market with AI, and AI exposure. And of course, energy play is, we think AI energy traders are very important trend going forward as well. So these are all things that, even though they require lots and lots of work, that we feel it's super important.
Yeah. Yeah. So to summarize, giving enough long enough time, such as 10 to 15 years for the thesis to play out, and still stay nimble and active, monitoring the market trends and modify the thesis as needed. That's how you generate extra alpha for your clients.
Yeah, I like to quote Stanley Druckenmiller, right? So Stanley
Okay.
Druckenmiller, for those who aren't aware, I'm sure you know Austin because I know you're a big finance guy. But for people who aren't aware, he ran one of the most successful hedge funds in the world, Duquesne Capital, 30 years, never one down year, average about 30%.
Hmm.
And Stanley Druckenmiller's approach is I concentrate my bets and I focus on my winners and I basically put all my eggs in one basket, but I watch that basket like a hawk, right? So, which is completely different from kind of the normal, a normal investment advisory approach, which is, we diversify and put into many baskets. So, I'm not a hedge fund, right? So I'm not Stanley Druckenmiller, but I do like lots of elements of his approach, and we do believe that a lot of his key investment approaches are super valid, super sound, and we do try to follow some of those characteristics. So yes, that's kind of like that's how I would say we kind of look at portfolio management.
Okay. Sounds good. And one thing I wanted to get your take is I I do real estate. I invest in a lot of real estate, and I do have a decent size of a stock portfolio. But I tend to get surprised when a company announced something that I'm completely blindsided, and there's a huge upswing or downswing to the value, which I feel some of the returns is not in my control. But on real estate, the macro environment changing, but usually it gives you enough time to modify your portfolio, and you can plan accordingly. So there's no such a big swing of value. What do you think about the stock market, and how do you address those like over 10% overnight?
Yeah, no, it's a good question, Austin. Yes, you are correct. I mean, when you're looking at equity markets, when you're looking at high growth companies, the market can be very dysfunctional in the short term, right? Or it can kind of be very emotional in the short term, right? And of course, we can't control any of that. What we can control is, of course, our conviction. Is how much do we have believe in the company, in this company that we're investing in. We can control the position size, right? So we can decide how much the size of our investment relates to our conviction for a company that we invest in. Right? What we also can control is the entry and exit point, right? So we can, this is where kind of some tactical analysis comes in. Is even though we found what we believe is the right company, we can decide what's the entry point, and then if we're either wrong or if we want to take profits, then we can decide what the exit point is as well. We can set the price where we want to exit at. So, I mean, these are the some of the things that we can control. Now, having said that, if, for example, in the past few days, right, we've seen kind of tech stocks, move in very large swings, we don't want to throw everything out based on price action, right? Even if we seeing one of our portfolio companies, have a big down day, where we need to look at it from the lens of what's changed. Okay, yes, the price has changed, right? The price has either dropped or gone up. But besides the price, what else has changed, right? And fundamentally, has their story changed? Is the thesis broken? Is their business fundamentally different than it was before this price change? So then we go through a checklist, right? So if we see that really nothing's fundamentally different or broken about the company, then that tells us we either hold, or it's a very high conviction, it gives us an entry to buy it more at a more attractive price. Right?
Mhm.
So that's kind of how we think about portfolio management and, and kind of movements and volatility in the stock market.
Got it. What do you think about founder-led companies? Do you think it's a good performance indicator, or it's just a type of company?
Yeah, I mean, founder-led companies are super interesting, I think, because they've been lots of studies. There was, in fact, a really famous study out of Australia about founder-led companies, and they found that something like founder-led companies outperformed all non-founder-led companies by like kind of a 40% margin. Is like a really big margin. Overall, our take is that we tend to like founder-led companies, but we have to have a caveat, right? Not every founder-led company, right? So kind of our thinking process is that typically founder-led companies can do better than non-founder-led companies for different reasons. So number one, obviously, is skin in the game, right? So they tend to have lots of high ownership in the stock, and they tend to stick around for many, many years, like, more than a decade, in some cases, 2 decades or longer, right? Number three is they're they're not managing for quarter to quarter performance. They're really managing more for a legacy, right? Because this is really, the legacy that they're leaving, right? So, we've seen lots of great examples in the marketplace, and we can talk through a couple of them. Obviously, the most obvious, one is Elon Musk, right? Tesla.
Yeah.
That's a super easy one to talk about. Everyone knows that story. Some other stories that I think are super interesting, is Robinhood. Vlad Tenev, Robinhood, founder led. So we can see Robinhood is leading fintech company, super innovative, constantly releasing new product launches, new product releases. They have crypto platform, and their entire moat is very different from your standard investment brokerage firms like your Charles Schwab's or Fidelity, because they don't have a branch network, right? So it's 100% online, remote, app driven, and so they don't have that cost center built in. So they can offer those super attractive incentives to bring on more clients. Right. Palantir is another really good example. One of our core portfolio holdings, Alex Carr, a founder led. super aligned with the performance, the long-term performance of the company. And we can see them every single quarter, announcing really big contracts with both on the commercial side and on the US government side, right? So these are all great examples of founder-led companies where we can see the difference. Like, I like to, people like to talk about founder-led, but if you just kind of look at a literally, you could pick so many companies at S&P who are not founder-led, and you can kind of see what happened after the founder stepped away. The
Hmm.
list goes on, like Starbucks, okay, right? So we all,
Hmm.
happened to Starbucks after the founder left, right? He had to come back twice, right? And then still, the last CEO, they had to fire him because, he simply was, same store sales were dropping year over year, right?
Yeah.
You know, there's so many examples on Nike, right? So,
Hmm.
after the founder left, they had a good period of growth, but then the last 5-10 years was been really, really stagnant, right? So that's another example. Lululemon, more recent example, right? The founder left, and so we saw what happened. Sales completely stalled, right? And so even the story kind of repeats itself over and over again because they hire these professional managers, right? And they're only in there to manage quarter by quarter expectations, right? And to get their bonus, but they're not really in it for the long game. So these are really, I think, important areas. And one piece of the puzzle that we look at when we look at portfolios.
Yeah, I think that makes total sense. I used to work in New York and then I moved to California and working in Silicon Valley. And one thing I noticed is Silicon Valley, at least the people that I interact with, are more long term focused than quarter by quarter, which gives market inefficiency that you as an investor can take advantage of. Is if you know this takes more than a quarter and it's actually the right thing to do, sometimes the market misunderstands that opportunity that quarter and it creates a price gap where you can invest or sell, or there is something that you can do to take advantage of that. So
Absolutely.
yeah, I understand your thesis, and I'm a real estate guy, so I would love to understand how you approach real estate in your portfolio construction. If there's a component for that, and what's your advice typically for real estate?
Yeah, we can definitely talk about real estate. Yeah, I mean, real estate is super interesting, I think, because first of all, a lot of my clients who, I work with, they tend to be in very expensive cities, right? Like we talked about this earlier, right? Silicon Valley, Bay Area, Los Angeles. I have clients in Hong Kong as well, another super expensive real estate city. And so, kind of the way I think about real estate is that I think real estate is, first of all, it's great. I mean, everyone needs a place to live, right? So it's just going to be most likely one of their core pieces of your assets that make up your net worth. And if you live in one of those high cost of living cities, it's probably going to make up 50% or more of your entire net worth, right? So that's totally makes sense.
So
Where I
you
kind of help
actually
clients.
count, sorry to jump in. You actually count the primary real estate as part of the investment, or you actually separated this? Because it's more consumption based. It's a living
Yeah.
style. They didn't choose that place just because goes up. It could be kids, it could be the location to school to company, like their employer. So I don't think, in my opinion, I don't think the primary residence should be counted as a part of the portfolio. Any thoughts on that?
Yeah. No, definitely good point. I don't think of it as part of the portfolio. We view it as part of their net worth, right? So the portfolio is kind of, their investable amount, what's liquid, what we can actually invest. Obviously their home, that's simply just part of their net worth figure. And, we're not, they're not planning to kind of trade that and buy and sell that, right? So it does come into play though in terms of how we look at their overall risk. Because if you think about it, like if you have a home in the Bay Area, easily it's 2 million, right? Okay, and then you've also got your income from, let's say you work at a big tech company, right? You've got your income. Most of your income is being, you're depending on that income from your employer, and so that's a good size right there. So I guess what we're trying to do is just kind of think about things in terms of buckets, right? So real estate's always going to be one of the core holdings for our clients. Then the question really becomes, you know, when clients ask me about, okay, well, should I be investing in more real estate, or there's an opportunity to buy a second investment property, right? Or should I invest in REITs, right? That's actually a very, very common discussion point is, are REITs attractive? What if interest rates come down? Should I be looking at REITs? So these are all things that can be explored. Now, the way we think about it is that given that your home is already probably 50% of your entire net worth, and
Mhm.
that's as a real estate assets, REITs, we want to think through that. Yes, you might be getting a decent income fit into your overall net worth picture, right? And the type of returns that we would expect from a slice of that REIT investment, how does that fit into your overall goal, of your long-term retirement planning, right? So always kind of start up with that slate is, how does any one investment, whether it's real estate or stocks or equities or anything, fit into your overall picture? So that's kind of the way I like to frame the discussion. So yeah, in some cases, the answer could be, Austin, yeah, it can make sense to, we can add exposure to REIT. I do have clients that rent, right? I have some younger clients, they actually don't own a home even though they live in a super high cost living city. They actually don't own a home, right? And so we can have that discussion, and in some cases it might make sense to have them look at either an investment property or exposure to REITs. And so we'll run the analysis. We'll kind of go through the whole investment process and talk through it with them.
Yeah, in my opinion, I have a lot of understanding about REITs, and I think because they're perpetual vehicle, they're not incentivized to have big outsized capital gains, which is usually how real estate is actually delivering value. They are more rely on rental income. So how they capitalize that rental income is they put a lot of fees to the operations. So in general, I think they're focusing on high class or highly steady income assets which doesn't really outperform. I believe, alignment is more important than the perceived dollar return. If the alignment is right, such a lot of private structures, that is actually going to create a ton of return. Yeah. So I would love to understand a little bit more about you focus on technology companies and personally, by the way, here's my hot take here. I think because AI is highly concentrated, it's bigger dollar, bigger play, way more than Internet 1.0, way more than SaaS. I think because of the capital required, it usually would take players with big war chest to win. Where could that be? It could be Silicon Valley, it could be some other places, but I think it's going to be more concentrated than prior generation of technology diffusion and because NVIDIA is going to sell the large amount of chips to the entire world. And where is NVIDIA? NVIDIA is here in the Bay Area. And who benefits directly from the NVIDIA's success, right? It's the employees and shareholders. And it will have such a wealth concentration effect that further pushes up Silicon Valley or some other tech places real estate price. So I'm a long-term bullish on this because I think AI is quite wealth concentrating. But that's my take. So I'd love to exchange ideas after this. Yeah.
I feel like with AI today, even though the media likes to talk about it, people don't really have understanding of how prolific it's going to be over the next 5 years. You have to be able to kind of be able to pick the right companies. This kind of goes back to a study I like to think of, Austin. It's called the Best and
Mhm.
Binder study. Best and Binder study is a very well-known study done by a finance professor out of Arizona State University. And he basically studied the entire US stock market for a 90-year period. And what he found was that only 4% of all the companies in the US drove 96% of all the returns. So if you think about that, that's a mind-boggling number. So basically, when you're investing in an S&P 500, basically you're only investing in 4% of companies that are actually driving literally all the returns. The
Mhm.
other 96% basically are underperforming or just performing at the same rate of return as treasury bills. So this is actually super interesting, right? Because if you think of allocating capital, right, you want to allocate capital where it's going to be working hardest for you. What most people do is they actually just kind of put it into an index fund where 96% of your money is actually going towards returns of treasury bills. And so this is kind of goes back to our core approach is that, we want to be investing in the 4%. We want to be looking at those winners. And yes, and the price of admission is volatility, right? Because investing in winners means that, they tend to go up, but they can also come down over,
Mhm.
volatility is going to be higher than putting in a basket of 500 companies. But we would rather do the work and actually try to pick the 4% winners and have that optionality as we talked about, rather than just kind of you know surrender to surrender to the index.
Sounds great. Yeah. So my last question is, I know that you have an integrated approach. You not only focus on wealth planning, but also some of the tax planning and other services. Can you tell me more about that? And why do you think the market isn't offering that?
Yeah. Yeah. I mean, yeah. So what we do is as we talked about, is we also offer full financial planning for our clients. Myself, being not just a financial planner, but I actually do have that US, China / Hong Kong background. I speak Mandarin, speak Cantonese. I have clients who do kind of live cross border lifestyle. So, I think a perfect example, I have a client, Airbnb. He just relocated to San Francisco from Beijing Airbnb. So he's planning to work at Airbnb for a few years in San Francisco. So you know that's great. But then he has lots of tax planning that he needs to do it because U.S. tax planning is completely different from China tax planning, right? And then you're on top of that, he's working with a U.S. tech company. So he's getting his RSUs, and he needs to kind of decide, what's the best way to think about, how to manage his taxes from his RSU standpoint. And then from a long-term point of view, he has to think about retirement planning, right? So then that's where we can kind of run scenarios and talk through that, right? Because if he's planning to return back to China in 5 years, so he's thinking his assignment, he's probably going to stay for 5 years and then move back to China and retire. Okay, that's great. But then we need to plan around that, because then he's going to have his 401k contributions set, by his company. Does he open an IRA while he's still in the US? What about property? So does he want to buy a property here? Great, you can buy property, but then what are you going to do with that property after 5 years when, you move back to China, right? And then, of course, then there's legacy planning, inheritance planning, because he has children. So maybe his kids want to actually study in the US for university, one day, right? And so there's so many discussion points that we can have around cross-border planning. And, I think the reason why a lot of other advisors don't kind of get into this area is because they just don't have that specialty, right? They're very US focused, right? So because I worked in Hong Kong, I also worked, with clients in China. So I do have that viewpoint, and I think it's quite helpful. In absolutely, I see a lot of these cases, right? Because even with all the talk about what's happening in the world, U.S.-China relationship, it's only going to get more and more complicated, and there's so much movement in terms of our economics. We're completely reliant on each other, right? So that there's no detaching from that, right? It's just how do we manage that for clients?
Yeah, sounds great. Well, really appreciate you sharing all the insights. I think you had really built a very different business and very unique. I have a lot of interest in learning more about the business. If somebody wants to reach out to you, where can they find you?
Yeah, I think the first place is they can check out our website. It's paraibawealth.com. So PARAIBA wealth.com. And then the other thing they can do is I just started a YouTube channel. So trying to do more content, so talk about investment strategies, our way of thinking. So you can find us on YouTube. It's called Unindexed Wealth. So we can, we also post quite regularly there. So yeah, those are the two places that you can reach me.
Sounds great. Well, thank you so much for taking the time. Really appreciate it.
Yeah, appreciate the time, Austin. It was great chatting with you.